Somewhere in Washington, D.C., inside a building that looks more like a federal courthouse than a financial institution, 12 people sit around a table. They are not elected, they do not answer to you, and roughly every 6 weeks, they make a decision that determines whether your savings grow, whether your loan becomes affordable, whether your business survives, or whether the economy quietly starts bleeding out. You've probably heard their decision announced on the news. Maybe you caught a headline, Fed raises rates by 25 basis points, and then you moved on with your day. But here's what nobody tells you. That number, that single, almost boring number, is not just a policy announcement. It's a signal, a lever, a pressure valve on a machine so large, so deeply wired into every financial decision on Earth that even the people operating it don't fully agree on how it works. This is the story of interest rates, not the textbook version, the real version, the one with consequences. Let's go back to a moment most people alive today have never experienced. 1980. Paul Volcker is the chairman of the Federal Reserve. Inflation in America is running at nearly 15%. That means the dollar in your pocket is losing value so fast that buying a house, filling a tank of gas, or planning a business is basically gambling. Volcker does something almost unthinkable. He raises the federal funds rate, the key interest rate the Fed controls, to 20%. 20%. Think about what that means. If you're a business and you want to borrow money to expand, you're paying 20% interest on that loan. If you're buying a home, your mortgage rate is somewhere in the high teens. Suddenly, debt is not just expensive, it's punishing. The economy enters a brutal recession. Unemployment spikes. People are furious. There are protests outside the Federal Reserve. Lumber dealers literally mail pieces of wood to Volcker's office because home construction had collapsed. But inflation breaks. It falls from 15% to under 3% in just a few years. Volcker basically detonated a bomb inside the economy to kill one specific monster, and it worked. That's the machine. It burns things to save things. So how does it actually function? Let's walk through this slowly, because the mechanism is elegant in a way that's almost sinister. The Federal Reserve sets what's called the federal funds rate. This is the interest rate that banks lend to each other overnight, short-term, to manage their daily cash needs. Banks are constantly borrowing and lending to each other. The Fed controls the price of that borrowing. Now here's the chain reaction. When the Fed raises that rate, banks pay more to borrow from each other. So naturally, they charge more when they lend to you. Your mortgage gets more expensive. Your car loan gets more expensive. Credit card rates climb. Business loans become harder to justify. People borrow less. They spend less. Demand across the economy cools. And when demand cools, prices stop rising as fast. Inflation slows. When the Fed cuts rates, the opposite happens. Borrowing becomes cheaper. People and businesses take on more debt. They spend more. They invest more. Economic activity heats up. Simple, right? Except it isn't, because this machine has a lag. When the Fed changes rates, the full effect on the economy doesn't show up for 12 to 18 months, sometimes longer. That means the Fed is essentially steering a car by looking in the rearview mirror and guessing where the road is going. In 2021, inflation started climbing. The Fed called it transitory, a temporary blip. They waited and waited. Then in March 2022, they started raising rates aggressively. 11 rate hikes in roughly 18 months, the fastest tightening cycle in 4 decades. Was it too late? Too fast? Economists are still arguing about it. But that's the thing about this machine. Nobody gets a clean answer until after the damage is done. Now let's talk about what this does to your money, specifically, because this is where most people's eyes glaze over, and that's exactly when they should be paying attention. When interest rates are low, cash is basically worthless. Putting money in a savings account earns you almost nothing. Bonds, the safe, boring investments that retirees rely on, pay almost nothing. So where does money go? It chases risk. Low rates push investors towards stocks, real estate, venture capital, cryptocurrency, anything that offers a return higher than zero. Asset prices inflate, markets boom.
A startup with no revenue in a PowerPoint deck can raise millions. A house in a mid-sized city suddenly costs twice what it did 5 years ago. This is not an accident, it's a feature of the machine. The Fed cuts rates, people get richer on paper, they feel confidence, they spend more, the economy grows. The technical term is the wealth effect. The practical term is your 401k going up makes you feel like buying a new car. So you do, so some factory somewhere makes more cars, so those workers get paid, so they buy things. But here's the uncomfortable math.
When rates stay low for too long, and they stayed historically low for nearly a decade after 2008, you don't just inflate asset prices, you inflate expectations, you inflate risk appetite. You inflate the illusion that cheap money is the natural state of the world. And then the Fed raises rates, and suddenly the math changes for everyone, everywhere, all at once. The startup that raised money at a zero interest rate valuation suddenly looks absurd to investors who can now earn 5% on a treasury bond with zero risk. The housing market freezes because buyers can't afford the new mortgage payments. Pension funds that loaded up on long-term bonds to chase yield find themselves sitting on massive, unrealized losses. Silicon Valley Bank, one of the most prominent banks in American tech, collapsed in 2023, largely because of this exact dynamic. They had parked billions in long-term government bonds when rates were low. When rates rose rapidly, those bonds lost value. When depositors panicked and pulled money out, the bank didn't have enough liquid assets to cover it. A bank that had been celebrated as sophisticated and well-managed was essentially wiped out in 48 hours. The machine had shifted. They hadn't noticed fast enough. Here's where it gets philosophically uncomfortable. The Federal Reserve's mandate, as written in law, is to achieve maximum employment and stable prices. 2 goals. That sounds reasonable, even noble, but those 2 goals are often in direct conflict. To fight inflation, you raise rates, slow the economy, and risk unemployment rising. To fight unemployment, you cut rates, stimulate borrowing, and risk inflation rising. So the Fed is permanently navigating a tension that cannot be fully resolved. It can only be managed. And the management is not precise. It's more like trying to land a plane in fog using instruments that are 6 months behind real time. The irony is profound. This institution, which has more influence over your financial life than any elected official, is essentially making educated guesses. They have PhDs in models and centuries of historical data, but they also have a track record of being surprised by the 2008 financial crisis, by the 2021 inflation surge, by the speed at which things can unravel when trust breaks. Former Fed Chair Ben Bernanke once said that monetary policy is 98% talk and 2% action. What he meant was that the expectation of what the Fed will do matters almost as much as what it actually does. Markets price in Fed decisions weeks in advance. The signal is half the mechanism, which means the Fed is partly in the business of managing psychology, of shaping what millions of investors and consumers believe is going to happen next. And belief in financial markets is not a soft variable. It moves prices. Zoom out even further, and the picture gets stranger still. The Fed doesn't operate in isolation. There are central banks in Europe, Japan, China, the UK, and dozens of other economies, all setting their own rates, all managing their own machines. And these machines interact. When the US raises rates, the dollar typically strengthens because global investors move money into dollar-denominated assets to capture higher yields. A stronger dollar sounds like a good thing if you're American, but it means every country that trades in dollars, which is most of the world, suddenly finds their imports more expensive and their debt harder to service. Sri Lanka's economic collapse in 2022, Pakistan's IMF crisis, Egypt's currency freefall. These are not isolated failures of local governments alone. They are, in part, downstream effects of a machine calibrated for a single economy that is also the engine of global finance. The Fed sets rates for America. The world inherits the consequences. And America itself is not immune to its own machine misfiring. The more debt a country carries, the more sensitive it becomes to rate changes. The U.S. government is currently paying somewhere in the range of $1 trillion a year just in interest on its national debt, not paying down principal, just servicing the interest. That number climbs every time rates stay elevated. At some point, the question stops being economic and starts being arithmetic. So where does this leave you? The machine is not evil. It's not conspiratorial. It's a genuinely imperfect tool trying to do something genuinely hard: keep a massively complex, interconnected, human-driven economy from flying apart in either direction. But it is a machine built on assumptions. The assumption that inflation can be controlled through borrowing costs. The assumption that employment and price stability can be balanced. The assumption that the signals feeding into it are accurate and timely enough to act on. And machines built on assumptions fail in interesting ways when the assumptions stop being true. Right now, the debate inside economics is not about whether interest rates matter. That much is settled. The debate is whether the models the Fed uses are still fit for a world of algorithmic trading, instant capital movement, viral bank runs on social media, and geopolitical supply shocks that no interest rate can fix. If inflation is caused by a war disrupting wheat supplies, raising rates doesn't make more wheat, it just makes borrowing more expensive while people still can't afford bread. If housing prices are high because there aren't enough houses being built, raising rates doesn't build more houses. It makes construction loans more expensive, slows new development, and makes the shortage worse. There are things this machine cannot fix, and the risk is that we keep turning the same dials expecting different results. The 12 people in that room in Washington will meet again in a few weeks. They will look at the latest data. They will argue. They will reach a consensus, or something close to it, and they will announce a number. That number will ripple through bond markets in milliseconds. It will move mortgage rates by Friday. It will influence whether a company in Jakarta can afford to refinance its debt, whether a first-time buyer in Ohio can close on a house, whether a pension fund in Norway has to rebalance its portfolio. And most people will catch the headline, maybe feel a vague sense of relief or concern, and move on. But now you know what's behind it. Not just a policy number, a machine, ancient in its logic, modern in its reach, operated by humans with incomplete information, trying to manage something that has never been fully manageable. The question worth sitting with isn't whether the machine is working, it's who it's working for, and what happens when it can't tell the difference anymore.